Welcome back, everybody. Do you remember in 2021 when the market was at euphoric levels, unprofitable growth companies were all the rage, Bitcoin was at all-time highs, and retail investors started trading the market like never before? Well, that ended badly, at least for a while there through 2022. But in 2023, things finally started to turn around. And now in 2024, we're back to the market experiencing all-time highs, but instead of GameStop and AMC, we have Nvidia and Meta. But Bitcoin is there once again and at new all-time highs, and retail investors are pouring money into the market. But is that a good thing, or are we on track for another bubble to pop that's going to send the market crashing? Well, in this video, we're going to talk about what's driving interest in the market, compare the fundamentals of today to what they were in 2021, and discuss what we should be doing about it as investors. So let's get started. Now, after a painful 2022 that saw $7 trillion of market cap just disappear, the S&P 500 has since gained over 36% in the 14 months or so since. And certain companies and sectors are doing significantly better than that. You have Meta, that's up over 300% over that time, and the AI narrative has made semiconductors the new hot industry, with Nvidia being the stock that more than any other has driven the market. And it's up an astonishing 500+% over that time. And the scary part is that the momentum seems to still be growing.
There's no way to quantify this directly, Tom, but in a way, is there any way to kind of gauge how much of the buying of Nvidia is just people who love Nvidia, love the story, they love the data center side, whatever it may be, and that options-related move that may have nothing to do with the underlying fundamentals of the business?
Well, I would say when you get to the point where Nvidia is right now, very little of the trading in Nvidia has to do with the fundamental story behind Nvidia. You're talking about a stock at this point that it's a $900 stock that's trading with penny-wide markets. The depth of liquidity today in Nvidia was off the charts. I mean, it was the number one stock traded on our platform today, and it just crushed everything else as far as just number of orders entered in Nvidia. When you can trade a stock with, almost a 60% implied volatility that's trading literally in penny-wide markets with a $900 stock, you're talking about something that just attracts people. It's just an opportunity. So whether you're bullish or you're bearish, everybody just loves opportunity, liquid opportunity, efficient opportunity. That's what attracts. That's why the money is attracted there.
Now, regardless of what he said, I do think there are a lot of people who are buying Nvidia for a long-term hold based on fundamentals and not just momentum, but we're going to get to that in a minute. But what this means is that there's a lot of momentum traders involved with it as well, which means that there are likely to be large swings both up and down, which can make it tough for long-term investors because the price volatility is going to be so high that it plays with our emotions. But even though the gains have felt parabolic, I think the Nvidia hype is much different than the GameStop and AMC hype in 2021.
And do you see it continuing, Tom?
Well, at this point, Brian, there has been, it's actually picked up steam every day. I mean, today was kind of, it picked up steam. And if you look at the markets tonight, especially with Costco kind of missing, and just like you talked about Broadcom missing, Nvidia is up $17 tonight post-market. It's trading right now. It's up $17, trading $9.43. I think it closed at $9.26 or $9.27 or something. So, this stock is just, it's a beast. And it really is bringing a lot of retail customers back, because this is nothing like a meme stock. This is not GameStop at all. This is a real company, a multi-trillion-dollar company that is bringing a lot of people into the game. It's kind of like a replacement almost for Tesla, what Tesla was a couple of years ago.
So if Nvidia isn't a meme stock, does that mean that all the crazy gains and all-time highs are actually different this time? Now, in general, there is definitely some FOMO related to AI. And of course, not all AI stocks are the same in terms of quality and fundamentals. Plus, while Nvidia is a real company at the forefront of the most exciting industry, their current price assumes that their astronomical growth rates are going to continue. But they are definitely a market leader whose customer base are the richest companies in the world, and who continue to generate insane cash flow and are spending it on Nvidia products and services. So there's definitely a great business there, which I would say is significantly different than the GameStop and AMC stories. But with all the trader interest and momentum, it's going to see wide swings on any bit of interesting news, which is going to make it a wild ride. And speaking of wild rides, what about Bitcoin? In 2021, Bitcoin dropped from $69,000 all the way down to $16,000 in about a year's time, with many people saying that it was just about done. But a little over a year later, Bitcoin is at fresh all-time highs, and this time has approved spot Bitcoin ETFs that are in the market and doing well.
To your point, I've been talking to people on the ground here, and what they're really all coming back to is the record flows of institutional money into the ecosystem thanks to these new spot ETFs. Today's big jump up in price, you saw that happen right around the time that U.S. stocks began trading, which goes to this larger narrative, Brian, that spot Bitcoin ETFs have been a major driver of this rally. Collectively, less than 2 months, these U.S. spot Bitcoin ETFs have brought in more than $56 billion.
So the ETFs opened up interest to retail investors who just wanted a simpler way to get exposure to Bitcoin's gains, but it also brought along fund managers and institutions. So while it's at a similar price level to 2021, most people view it as a much more established asset class with a steady stream of ongoing demand outside of just retail. So again, it's another example of if we're just looking at the price and not the fundamentals of what's going on, then we may just assume that it's very similar to 2021. But to me, it looks a lot more attractive than that. Okay, but lastly, what about the broader market as a whole? The S&P 500 is also around all-time highs with many of the top companies in the index at all-time highs as well. So clearly, we should be staying away, right? Well, Stephen Parker from JP Morgan talked about this, so let's listen in.
People are wondering if they missed out. You're saying it's not too late.
No, I don't think it's too late. Last year markets certainly were climbing the wall of worry. Nobody wanted to believe in one of the strongest rallies that we've seen in a long time. And now you get headlines about new all-time highs, and that gives people a reason to think that maybe it's time to sell. The reality is if you look back historically, buying at all-time highs has actually been a very good strategy. A year later, you're typically up 70% of the time, close to 10% returns. So I think the focus should be less around the headlines and all-time highs and more around the fundamentals. And we think that the earnings story is compelling. We think that the policy story is going to offer tailwinds. And we think that the corporate sector is in really good shape.
And I've talked about this multiple times recently in my newsletter. When I look at the fundamentals of the top companies in the market, I don't see wildly unprofitable bubble companies. I see tech giants that are earning more money than ever. Now, obviously, that doesn't mean that there aren't any risks, because there are. And Stephen Parker talks about that a bit here.
What's the counter case for this? I think a lot of people want to believe this. There's a ton of money on the sidelines, and there's probably a pretty good argument for it. But if you had to make the counter case, if you had to argue on the other side, what would you say?
I think the counter case is that, one, markets seem to be coalescing around this view that inflation is softening, which allows the Fed to ease because of that inflation story, not because the growth story is really bad. I think if we were to have some sort of shock and see a downside surprise to economic growth that forced the Fed's hand because of a slowdown rather than inflation cooling, that's potentially a big risk to the market. But that's not our base case. It's not showing up in any of the data we're seeing.
So to me, even though there's a possibility for some correction, the companies at the top of the market don't look that ridiculously overpriced as some people would have you believe if you actually look at the fundamentals of the company, even if the price may not look that attractive at first glance. So what should we actually be doing about it as investors? Now, regardless of what's happening in the market, there are basic principles that should just always apply. Like look for companies that are generating cash flow or just in general meet your personal criteria. Now, if you have zero interest in Nvidia or AI or semiconductors or even Bitcoin, and you'd prefer to stay away from all of that, then the plan is simple. Just stay away and work your plan. Don't worry about it. Now, if you're holding Nvidia or semiconductor stocks or Bitcoin or any of the Bitcoin ETFs, then expect volatility, with a lot of wide price swings both up and down, as well as crazy headlines or commentary that's going to play on your emotions like this.
Well, the difference is the contribution from Nvidia. Nvidia's at $927 a share. Right. Stock split Nvidia?
Yeah, please.
So you would favor that? You think you'll go for it?
I mean, they've done it before, so I think it's likely. I think it would be great if Broadcom split as well, and some of these other stocks that trade at these, really high levels. It makes it harder to manage portfolios with them in the portfolio, harder for the retail investor. But, we'll take what we get. We'll take dividend increases. We'll take share buybacks, whatever it takes to drive the stock price higher.
And what helps with managing that is to have a clear plan of what you expect to get out of the investment. Is this a long-term thing? Then ride out the waves and find ways to ignore the news and just don't worry too much about it on a day-to-day basis. If this is more of a trade to you, then have a clear strategy of when you're going to take profits and or get out and follow that plan. Now, if you're interested in adding things like Nvidia, semiconductors, or Bitcoin to your portfolio, the best approach, in my opinion, is to start with an allocation that's small enough to give you exposure to the high growth opportunity, but not big enough to do any real damage to your portfolio if it goes south. And that's part of the beauty of an asymmetric bet, which I think is explained really well here.
But in general, we've been at such a torrid pace for the S&P, hitting record high after record high. It's not the only asset class, though, that's been doing that. We've also seen record highs in gold and this week, record highs in Bitcoin. What does it say about diversification, and what does it say about whether you should be putting something like Bitcoin in your portfolio?
It's an odd barbell market, right? I think, it's very interesting what you're raising. And, coming from investment at a platform with a lot of retail investors, obviously, I have to point to the advent of ETFs. I mean, the decision by the SEC to enable spot Bitcoin ETFs is just going to be huge. And you're going to continue to see a tsunami of interest because now you have a liquid, easily available way to earn a Bitcoin return, and it's backed by major asset managers. So folks who weren't ready to dabble in the actual currency are now going to say, okay, here's my opportunity to get a little piece of this. And it has a lotto ticket-like aspect to it, right? So there's great research out there talking about the fact that even normal risk aversion in investors allows for some position in the portfolio in Bitcoin simply because it can only go to zero. And the skew on it is so high that, it has this opportunity to pay off dramatically.
And that approach to me is a good balance between completely dismissing and missing something you have an interest in and being reckless with your own money. Overall, though, while there have been some crazy gains, I think the 2024 market is considerably better than the one we saw in 2021 and will likely lead to a better overall outcome for retail investors who are putting their money to work, as long as they stick to their plan and set realistic expectations based on how much asymmetric risk they want to take. So what do you guys think about the current market? Do you think it's similar to 2021, or is it slightly different this time? Let me know down in the comments below. Now, if you don't want to deal with all the ups and downs and crazy news of the market, then you want to see a simple one ETF investment plan that works for most people, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins. And I'll see you guys in the next one. Peace.